One that I haven't spoken about yet, and we talked a little bit about this earlier, is private credit, which may or may not be in a bubble. And when we look around, the financial community, we see that there's been a lot of credit extended. There's been about $3 trillion raised in the last several years that's gone to work in, lending to companies, some of which are private, some of which are public. And what we don't know is whether or not, given that it's an opaque market because it's private, whether there are some rabbits in the woodpile that at some point along the way are going to jump out and create problems in the financial markets, the public financial markets, and have some negative impact on the banking community as well. It's not 2008. I don't think it's that big. I do think it's big enough to shake the tree or create a moment in the financial markets that would upset people and certainly get them a little bit unnerved about the state of affairs when it comes to those things. Not every credit is AAA. And when you have $3 trillion to put to work, you can't just lend to the top of the capital structure, right? And nor can you lend to just AAA credits. So we have seen that some of the credit quality has deteriorated. There have been some folks at places like Apollo who have suggested, in the software space in particular, some of those bonds, some of those credits are worth 30 to 40 cents on the dollar. We've seen investors try to redeem from private credit funds, and they've been prevented from getting all their money out. There's typical gates that exist in some of those investment vehicles, and it's creating a sense of unease in the financial markets as to whether or not somewhere over the course of this year we might have an event. Again, relative to that, 2008 was a rather unique shock. If you remember, we were all levered to the same asset class at the same time, residential real estate, and then layered on top of that was an enormous amount of derivatives that were levered by the banks. And so we had a near systemic financial collapse, both domestically and globally. That's not what this is, as far as I could tell. This is maybe more like a long-term capital event where a individual bank or a couple of banks run into trouble because they've extended credit lines into the private credit community. You have a failure somewhere, and then you get a market event. Then the Fed would be forced to cut rates and kind of restart the process. So that's one of the things I'm keeping a very close eye on, because I do think that that's a risk going forward that on top of all the other variables we may have to face somewhere down the road.